let's think about how we get the fair value of options. So this is in the Spiceland book, Recognizing the Fair Value of Options, and these would be the variables that we need, right? And most of these variables we can get out of, we can get this stuff out of the contract. What's the exercise price of the option? What's the term of the option? They actually ask you for the expected term. So if you believe that the stated term is 8 years, but you think that it likely will get exercised in a shorter amount of time, well then your expected term is going to be different. And then you also need the current market price of the stock as well as the stock, etc. Other things that you might have to factor into this is, well, if we're going to actually invest in the stock straight, well, what kind of a return would I have gotten from that if there were dividends? If I took the same amount of money that I'd pay for the option, well, what would be the risk-free rate of return during the term of the option? So if the expected term of the option is, say, a 5-year option, then the risk-free rate during the term of the option would be the 5-year treasury rate. Again, this is observable, expected dividends, observable, and also observable. The thing that's tricky is trying to come up with expected volatility of the stock. And that's what this video is going to attempt to do. Now, if you're interested more about option pricing theory, in the book you can go to Appendix 19A, and here's some discussion of that. Again, these are some of the variables. When things happen, the value of options changes. But we want to go in and start figuring out how to value options. Now, you will see this Excel spreadsheet, which is a blank Excel spreadsheet for a Black-Scholes model. And you can see current stock price, the current market price, the strike price, volatility, risk-free rate, time to expiration, dividend yield, and of course how many shares. This is in thousands of shares. So number of options, and one option to buy one share then would be, in this, 0.001, because that's one share. But I'm not going to give you a problem that's only got one share. And then what you put in the tax rate, right? What is the effective tax rate for the company? And then you're going to end up getting, these are going to be call options, as we mentioned, since they're employee stock options. Then we get the call price. So this is going to be the variables that are going to be, and you use this little spreadsheet. It's a simple Black-Scholes model, but it's effective to come up with what you think is the fair value of the stock option. So let's try to go after a particular company and see if we can come up with a value for it, right? Come up with a volatility. Let's calculate the volatility. I'm not going to come up with the fair value of an option contract, but we at least need to figure out what's the volatility. Dividend yield is pretty simple. We figure out what's the dividend that they're paying divided by the stock price. That's the dividend yield. It's giving me an annual rate of return. And of course the risk-free rate is we can go and get that market rate. So let's take a look at a particular company. I'm over here in Yahoo Finance, and if you've not watched the video on how to get data from Yahoo Finance, then you should probably do that. So what we're going to do is we want to look up a particular company. So let's look up, I don't know, I bet you Tesla has options, right? You would think so. Let's look up Tesla. There it is, TSLA. So let's look up Tesla. Let's take a look at that. Come on, get me there. Yahoo Finance is killing me right now. Let's get Tesla, TSLA, and search for Tesla. Here we go, Tesla, beautiful. All right, so we've got Tesla, right? And right now it's 442. It's up $18 today. I'm doing this recording on September 18th. Not really that interesting. And we want to go to historical data. You can see all sorts of information here. We go to historical data. So let's take a look at the historical data. All right? And here are the historical prices. Now we can expand this out. This is just going to give me 1 year's worth of data. I can ask for 5 years. I can ask for the max. I can ask for whatever. But let's just pull a year's worth of data from today going all the way back 1 year to September 18th, 2019. And we can also change the frequency. You can get daily, weekly, monthly data. Now, what you'll notice is that we're going to skip some dates here, right? 18, that's Friday, 17, 16, 15, 14. What happened to 12 and 13? Well, those aren't trading days. So the data that you have here is trading day data. And generally, there are 252 trading days. If you have a leap year, you might have an extra trading day in there, but we usually use 252 trading days. If we're dealing with weekly, that's simple. There are only 52 weeks. And if we're dealing with monthly, that's simple, only 12 months. But if you're dealing with daily data, it's 252 trading days. So this is the data that we have, right? We have the entire year all sitting right here for us, beautifully done, right? And what we want to do is we want to download this data. And you can see the little download button here, and I'm going to download that. And it's going to open up down here in my little browser. Thank you very much. And I want to open that up, and it should open up in Excel. And so here's my data, right? Everything that we just saw is here. We got close, we got adjusted close. Adjusted close is usually closing adjusted for dividends, or any splits, or any stock dividends. So that's our adjusted close. And you can see that back in 2019, the stock price was 48. Now we go to the current, and we see it's up in the 400s. Okay. So I might want to flip the sorting. First of all, let's view this a little bit bigger because this is kind of tiny. So let's double this up, get it a little bigger. I'm going to just widen that out. I really want to see the most current information because I may want to look at the most recent volatility. So in this, I'm just going to go and I'm going to resort this data. I'm going to sort it. I'm going to sort by the date. And I want the newest to the oldest, right? So that's just going to flip the script, if you will. Flipping the script. Okay, so what we are trying to do with volatility is we're trying to find out how volatile the returns are. And there's a couple of different ways to calculate returns. You can do what you would normally think about regular return, right? We take a look at today's price minus yesterday's price divided by yesterday's price. That should give us what today's return was. And there's another way of doing it, and I'll show that to you in a second. So we're just going to use the regular return. I'm going to name this column regular return. And it's simply, we'll use adjusted close. It's simply today's price minus, not equals, minus yesterday's price. Right? And I should put some parentheses around this, right? Because of order of operations. I want this done first. And I want that to be divided by yesterday's price. And that's going to give me the return. So 4.421% return. Okay? So that's a regular return. Now returns, if we think about if we think about finance a little bit, returns are not normally distributed or regularly distributed, if you will. They're log normally distributed. So another way of calculating returns is by using a log function. So here we're going to go log returns. And log returns, we're going to use this function ln, right, which is the natural log of a number. And it is simply the current price divided by the previous day's price. And this should get us pretty close to what the regular return is. Not very different, but you can see it's a little bit different. Either one's fine. Either one is fine. So for these, I'm just going to go and I'm going to copy all this down here. All the way. Don't do the last day because you don't have the previous, right? And this is just going to give me all of my returns for this entire period. I'll do the same thing over here. We'll just kind of drag this all the way down. And that's going to give me all those returns. So there we go. We got all of our returns, our daily returns, right? So now we want to say, okay, well, how variable are these returns, right? What's the variance of the returns? And a simple way to do variance calculations is we want to look at, we want to calculate the standard deviation given how many observations we are looking at. We're just going to look at a sample. So we're going to find out, we're going to do over here, we'll do it two ways. I'm going to expand both of these out here a little bit. We're going to do, basically, we're going to look at regular standard deviation. And I'm going to do another one for log standard deviation. Okay, so I'm just basically going to take these returns and get the standard deviations of these. And it depends on how much data that I want to use to calculate the standard deviations. That is critical. So if I've got a long dated option, maybe 8 years, do you think 30 days is a representative sample of data to figure out how volatile this might be over an 8-year period? Probably not. Maybe I need a year, maybe I need more, right? This is a decision you've got to make and defend. So let's just, for argument's sake, let's just do the last 30 days. It's not really what I would expect you to do for a long dated stock option. I would think you'd want to do something that is a little bit longer. But we'll just use 30 days just for illustration purposes. So we want to type in standard deviation. And there's a couple of formulas you see here. This one here is for the population. And this one here is for the sample. Right? So this is the estimated standard deviation based on a sample. And that's really what we're doing. We're doing a sample of 30 items. So that's the formula. And what we want to do is we want to put in the last 30 trading days. Not the last 30 calendar days, the last 30 trading days. So I'm just going to go down here and you can see the little counter there. And I'm just going to pull up 30 days worth of data right there. And close that off and hit return. So the daily standard deviation is 7.196%, right? All of this in these two columns, this is all percent. So we're going to change that, make this percentages. Give me a couple of, so 7.2%. We can just copy this formula over to the right. So I'm just going to copy and paste it, because now what it'll do is it'll do the same formula, and for the same length of time, but for column I. We're going to paste that. So log standard deviation, 7.34% volatility, daily volatility, 7.2, daily volatility for standard deviation. But when we do the volatility calculation in the Black-Scholes model, we want to see annual volatility. Now remember, this is all based on 252 trading days. So we don't want to use 365. We want to use how many ever trading days are likely in a return data set. And if you recall from your statistics that whenever we're trying to figure out, when you calculate standard deviation, it's based on the square root of your sample. So when they calculated this standard deviation, it's the variance, it's the square root of the variance divided by the square root of the number of observations. In this case, we had 30 observations. So when I want to find out what is the annual, I need to multiply it by the square root of how many ever trading days I have, or 252. So we're just going to take this, and we're going to multiply this regular standard deviation times the square root, there it is, the square root of 252. And this will give me my annual volatility of 114%. That's pretty volatile, right? And we do the exact same. I'm just going to copy this over because it'll do the exact same thing, but it'll do it for my log standard deviation. So we're going to copy over here, and log standard deviation, 116%. That is pretty volatile. That's very volatile. These options, because of the volatility, they're going all over the place, right? Very high volatility with Tesla, right? And if you think about it, just last week it was trading at 371, now it's at 442. That's pretty volatile. There's some volatility there. You got 21% down returns in some days, and you know it's all over the place. That's okay. So just for giggles, and this would be the, if you said, I'm going to use regular standard deviation, regular volatility, or log volatility, this would be the number you'd put into that Black-Scholes model. We go back over to our Black-Scholes model. When we put in the volatility, you'd put in that percentage, 114%. Just for curiosity's sake, let's see what Tesla's what they are doing as far as documenting what their volatility is. So let's take a look at Tesla. And we want to find their 10K. So I'm looking at all the different filings here. It's not on this page. Let's go to the next one. I didn't see it there. Oh, it's right here on the top. So let's go to their 10K. I'm going to pull up their 10K. And because I'm going to do a search within this, I'm going to actually open this up. I'm going to open up the HTML version of this versus the XBRL version. That way I can search within the file. So I think I'm just I can type in volatility, but there's probably a lot of this, mess in here around talking about volatility. So, I'm going to type in shoals. Right? Because I can't imagine there's a lot of shoals in there, right? And so it goes right down to what's happening here in our financial statement. So this is probably in footnote 1. If we scroll up here a little bit, or no, this is in management's discussion and analysis, right? In item 7. So they're talking a little bit about Black-Scholes, beautiful, right? Stock-based compensation. Now this is in their financial statements, right? So this should be one of their footnotes, I would imagine, or maybe again it's part of their. This also looks like. This is their financial statement. So here's note 2, their summary of significant accounting policies. So under the summary of significant accounting policies, they've got their discussion of the Black-Scholes pricing model. Right? Not really telling us what they think volatility is, but let's see what the next Black-Scholes. Oh, here's a table, right? And this is in table note 14, equity incentive plans. And here I have, they're using a Black-Scholes model. Here it is. And the weighted average assumptions of the following table, etc. But they don't tell you how long they're looking. But the volatility that they're reporting, at least in 2019, 48%. Well, that's a far cry from 114%. So they obviously are using maybe a longer dated amount of data to calculate their volatility. You do not have to replicate anyone's volatility. You've got to make your own decision. If you think 114% is a better volatility for calculating compensation expense, because remember, you put this volatility in there, it's going to increase compensation expense. Put in 114%, Tesla's compensation expense goes through the roof. You put a lower volatility in there, you have lower compensation expense.